Is the company in great shape? Is the company reasonably priced? The PE ratio. The price to earnings ratio is a simple calculation that may take a little bit of time to understand. But once you have it, it can be very useful. The PE ratio is the share price divided by the earnings. Let us imagine I want to buy an ice cream stand. The owner wants to sell that stand to me for $10,000. I'm estimated to make a yearly profit after tax of $2,000. This means it would take me 5 years to make my money back on this investment. Therefore, the price I paid divided by the earnings equals 5. $10,000 divided by $2,000 equals 5. This is what the PE ratio, or the multiple as it's commonly called, tells us. In the example above, I used the example of buying a whole business, and we considered all of the profits. The PE ratio achieves this same goal by using individual share price divided by the earnings per share. The PE ratio can tell you what kind of premium investors are willing to pay to get a piece of this company. PE ratios should always be considered in the context of the industry group. For example, compare the PE of companies in the same industry. This will tell you which companies are perceived to have the brightest future or the best products or services, as the investors are willing to pay more for a share of one company as opposed to another company that are in the same line of business. Imagine the 3 companies in this example are all in the same industry providing similar services. Company A has a PE ratio of 50. If 50 is the highest PE in the industry, then people believe this company has the best profit growth potential in the future. The company is perceived to be worth more, and therefore they're paying more per share of its current earnings. That means they expect future earnings to be higher. Company B has a PE of 25, and if 25 was more or less the industry average, then this company would be seen as a fairly priced stock for the industry. Company C has a PE ratio of 5. This company would be seen as an underperformer or a stock with potential value. If the earnings suddenly jumped for this stock, this could potentially be a good bargain. The PE ratio needs to be combined with other fundamental measures to get a much better picture of the stock. To give you an important sense of perspective on what average PE of a whole stock market is, let's have a look at this chart. Here we see the S&P Composite Index compared to the PE ratio of the whole index. In December 2009, we are at 20.12 PE for all these stocks. This is quite a reasonable level, perhaps even a little high, significantly down from 45 in the year 2000. As we all know, in 2000, too many people were investing too much money in stocks that had never really made a penny profit. This led to irrational exuberance, as the Federal Reserve called it, or as I call it, the dot bomb. As earnings rise steadily, so should the share price to reflect a reasonable price to earnings multiple. Bubbles and crashes in the stock market can be seen very clearly forming when the price-earnings ratio surges over circa 25%. So here you can see in blue the price-earnings ratio, and in green here you see the S&P Composite. And what we can see here, as we reviewed in previous sections, that the price earnings ratio here of circa 25% resulted in some rather huge crashes previously. And that essentially tells us that the stock market is very much overvalued. At the turn of the century, 1929, 66, in the 80s you can see, entering the 80s, the huge boom that we saw through to 2000, stock prices, or the price earnings ratio of the S&P composite, was extremely low. Here we can see it. So the 60s and 70s really brought the valuations of the stock market to really an all-time low. And from there we saw a huge surge. And here you can see now with the corrections in the beginning of 2000, that brought us down actually to a PE ratio for the S&P of 25, which was still somewhat overvalued. And then with the more recent financial crisis or credit crunch recession that we've seen, the PE ratio of the S&P dropped even further from circa 25-26% down to a very reasonable 12-13%. With the recovery that we've experienced since March 2009, we have seen the price earnings ratio increase again. So it's worth being very careful if we do see a resurgent recovery and potential boom happening in the future. When it gets above 25, 30%, 35%, this is very, very dangerous territory, and you need to be aware of that.
Wow, you're still here. Well, I guess you must have liked this video. If you did, don't forget to hit the like button. It will really help the channel out. And click subscribe if you want to be notified about future stock investing lessons, strategies, and software videos. Finally, don't forget to leave a comment or question below, and I will reply.